All right. Good afternoon, everyone. On behalf of the Atlanta Society of Finance and Investment Professionals and Voya, we welcome you today to an exclusive panel with the top portfolio managers in the nation. I'm Aradhna Kejriwal, president of the Atlanta Society. It's a pleasure to see a large audience today. We are more than 150 in attendance, I believe. And in that, we have more than 20% men who have registered to come for this. So that's amazing. Normally, that's the number of women CFAs in the world, and normally it's the women sitting on that side. So that's amazing. Thank you, everyone, for coming. So the panel today is the first event in line with the Atlanta Society Women in Finance 20 by year 2020 objective. And research shows that diversity of thought leads to better investment outcomes. Diversity does not necessarily mean that men are better or women are better. It just means that it's a better outcome all around. So the aim of the 20 by 2020 objective is to increase the women membership in the Atlanta Society to 20%. We are currently at 16%. Atlanta Society is ahead of most of the societies in the world, most of the 150 societies in the world. We had the first woman president in 1977. So we've been ahead, and we're trying to increase that level of women membership. This follows the CFA Institute Future of Finance initiative of increasing the number of women who join our investment industry, and also to retain the women in our profession and influence the culture within the firms. And the initiative is also to create a demand for diversity as an industry imperative. However, we have an uphill task in front of us as 45% of investors out there believe that diversity does not matter when it comes to managing investments. So at our society, we're looking for opportunities to partner with your firms to speak about our initiative, and we're increasingly also reaching out to different universities in the Southeast, because as you might be aware, the pipeline for the women joining our industry is drying up very quickly. And just in overall, the number of people who are joining the investment management industry is drying up, but when it comes to women, it's drying up even more. So this event is part of spreading that message to inspire women. We would like to thank Voya for graciously hosting this event. An event of this magnitude has multiple moving parts. So special thanks to the following folks from Voya. We have Pat Leopold, Kristine's assistant, who handle all the logistics, catering, signage, all of that. I know that's a huge task. We have Bob Lapierre from IT, who's handling our AV. So thank you. Robert Gant, who's handling the facilities team. Thank you so much. Thanks to Mark Alshul from Voya for putting this together, and also for helping out and working on the society's board very actively. Thank you, Mark. From the Atlanta Society's side, I'd like to thank Christy Loop for graciously agreeing to moderate this event, and of course to Kathy Ford, who is the backbone of the event. And I believe she's still sitting up front, registering everybody. All right, so on that note, let's start. Here's a brief introduction of our moderator and the panelists. Our moderator today is Christy Loop. She's the Senior Investment Consultant at Willis Tower Watson. She's responsible for the management of global asset pools for multinational corporations. She's a member of the U.S. Advisory Portfolio Group, charged with strategy and leadership for the firm's advisory clients. Previously, she's worked at William Blair. Christy is also a board member of the Atlanta Society, and she's serving her third three-year term on the board. And she's also a member of the CFA Institute. Thank you, Christy. Our distinguished panelists today are Kristine Hurtsellers. Kristine is the Chief Executive Officer of Voya Investment Management, which manages over $200 billion for external institutions and individual investors. Before becoming the CEO at Voya, she was the Chief Investment Officer for Fixed Income, managing more than $134 billion and 100 investment professionals. Christina was also at Freddie Mac, managing about $650 billion before that. Welcome, Kristine. We have Margaret Vitrano, Managing Director, Portfolio Manager at ClearBridge. Margaret co-manages the large cap growth and all cap growth strategies. She has more than 20 years of investment industry experience and had joined ClearBridge predecessor organization in 1997. Prior to ClearBridge, Margaret was at Citigroup. Welcome, Margaret. We have Laurie Brignac. She's the head of global liquidity portfolio management for Invesco fixed income and is responsible for providing senior management oversight of liquidity products in the US, emerging markets, and Asia Pacific regions. Laurie has been in the investment business since 1989 and has served as a member of the Tri-Party Repo Infrastructure Reform Task Force and participates in various industry committees, both in the US and globally. Welcome, Laurie.
Thank you.
We have Marianne Agretti. She's the managing director of Artisan Partners and is a portfolio manager for the emerging markets team. Prior to joining Artisan in 2006, Maria was a portfolio manager for DuPont Capital Management's emerging markets equity portfolios. And earlier in her career, she was a foreign exchange trader for Banco Ganadero in Bogota, Colombia. Welcome, Maria. We have Lisa Coleman, managing director and head of the global investment grade corporate credit team in the global fixed income, currency, and commodities GFICC group. That was a mouthful. Prior to joining the firm, Lisa was at Schroders, and she was serving as the head of the global credit strategies and the head of European fixed income. And previously, she's been at All America Financial, she's been at Brown Brothers Harriman, Merrill Lynch, and also at the Federal Reserve Bank of New York. So please join me, ladies and gentlemen, in giving a very warm welcome to our esteemed panelists.
Well, thank you again and welcome. I'm so excited to have the pleasure of sitting up here with so many esteemed executives, investors, and women. I thought a good place to start might be for each of you to spend a few minutes just talking a little bit more about your investment team, some of the strategies you're managing, and providing a bit more context around your areas of expertise. If you just want to start down the line, I think that'd be great.
Sure thing. Thank you so much. So to start, I'll start us out. I run the Voya investment management business here, and we have many different investment types that we oversee, predominantly fixed income. We manage about $155 billion of fixed income assets, about $50 billion active equity, as well as private equity, and then a multi-sector portfolio. So a good purview as far as different disciplines and markets. I think what we're most known for really are more customized things, so we haven't really been getting caught up in a lot of the active to passive pressures that you see in the market today. And, I love running the organization, and, before that I ran fixed income, so it's just been a great journey with Voya.
Wonderful, thank you.
Hi, everyone. I manage our large cap growth strategy, the large cap growth strategy at ClearBridge with my partner, Peter Bourbeau. I've been doing that since 2012. Prior to that, I was just a fundamental research analyst, so I feel like I came up from the bottom up in terms of my growth towards being a portfolio manager. If I think about our strategy and what we do and why it's been successful, it is that we tend to be valuation sensitive growth investors, which is such an anomaly and a contradiction of terms, except that I think especially in a market like we're in right now, being prudently thinking about risk and thinking about valuations can really help performance over a longer period of time. So that's what we focus on. We focus on finding really good quality businesses, but trying to buy them really well so that we can manage risk and hopefully generate consistent outperformance over time.
My name's Laurie Brignac, and I head up the portfolio management team for Invesco's global liquidity business. My team, I've got 12 portfolio managers, both here in Atlanta, London, and Asia. And along with our credit research colleagues, we've got 5 dedicated analysts to the global liquidity business. We manage a little over $100 billion as of quarter end in liquidity products, and that's effectively everything with a duration of 1 year and in. Our clients are primarily institutional clients. We've got banks, brokerage firms, sovereign wealth funds, and some corporate cash as well. And, obviously, big focus for us over the last couple of years has been reform, not only in the money fund business here in the U.S., now we're turning our eyes to EMEA, and obviously just working with the regulators just on liquidity in general, because as you know, cash is that one asset class that investors don't want to have to worry about. So, I'm really blessed to have just a tremendous team and colleagues, very safe pair of hands. I tell people if they want to work in the liquidity markets in the front end of the curve, you have to want to be the first ones in and last ones out, and just be very dedicated, and we're lucky to have that on our team.
Hello. I'm Marianne Agretti. I manage the portfolio, the emerging markets equity portfolio at Artisan Partners. Emerging markets is what I've done all my life. I'm from an emerging market. I'm passionate about emerging markets, and my career has been surrounding about the asset class. My team and myself, what we do is a very bottom-up approach to emerging markets, so we believe, and our commitment is not only in our investments, but in the people of emerging markets. So we do a very bottom-up, grounds approach, travel a lot to the region, spend a lot of our time visiting, understanding these markets, and that is really not only what we think gives us our edge, but really what motivates us. The opportunities that really are in this asset class in these countries are something that we have found exciting from the 2 decades ago, and we still find exciting today.
Great, and I'm Lisa Coleman. I work at JP Morgan Asset Management, and my team is global investment grade credit. And at last count, I think we're up to about 60 billion that my team manages. We're fairly evenly divided between people that are based in New York and people that are based in London. We have a team of portfolio managers, traders, and analysts, and all we do all day is think about investment grade credit and what we can do to improve portfolio performance for our clients. And I think what's been interesting is when I first started in this role, it was very much active management against a benchmark. And it's been interesting to me since joining JP Morgan in 2008 how that has evolved. And by that I mean really the different types of players that have come into the corporate bond market have been very interesting. It's no longer just people putting money into mutual funds, whether they be the US or whether they be European mutual funds, but large institutions out of Japan who are sitting on tremendous amounts of cash that they need to be investing, and they're looking for opportunities. Or it could be a European-based investor that might be looking for a global portfolio, but with a tilt to dollars. They may be buy and maintain, they may be total return. Some now look for unconstrained. So it's just been a really interesting journey for me over the past few years. And certainly being at JP Morgan, I've been right there in the hot seat for it all, so it's been great.
Well, wonderful. Thank you so much for your introductions. We appreciate it. I think we might spend a few minutes talking a little bit more, kind of delving into some more of your specific investment views and how you all are positioning your teams to navigate what's been a challenging and dynamic change within the industry. So Kristine, on that note, I think I want to get your thoughts around what are your views on the challenges of asset management in general as an industry, particularly as we've seen this huge migration from active management to passive over the past couple of years. It's hard to even look at any financial publications these days without seeing some more information on the trends, the flows, impact of ETFs, et cetera. And then also, how are you positioning your firm to kind of withstand perhaps, again, this increased volatility within the marketplace, just as it relates to uncertainty in terms of investor behavior, and how are some of the customized solutions you mentioned in your introduction helping better position your firm?
Sure. Yeah, definitely. I've been in the role of CEO of an investment management firm about a year, and I think that it's just the right time for me to be here. And that's because I'm an investor. That's why I'm up on this panel, is really my investment results running fixed income when the CNBC story came out about all of us. But the reason why I say that is that it's an opportunity where you have to have courage of your convictions. You can't be afraid to change. You have to have feedback loops and be willing to move. And it's a little bit of a sleepy industry that is sort of watching this active to passive thing keep going on, and it's a little bit like a frog in water. And why I say that is that we just need to get our minds around well, why is this happening? Where do we really need to compete, and where do we really need to differentiate ourselves? And so you're definitely seeing a very interesting shift within our industry as far as where people are willing to place their bets. And I would note the Invesco acquisition of the ETFs from Guggenheim. Part of it's a scale game, a global scale game, and a low-cost game, and Invesco's going to continue to compete very well there. And Guggenheim's kind of like taking table stakes to say, I'm going to double down on really being customized and specialized and being known for credit and that type of thing. And so I think all of our firms are going to start to have to align. We're thinking a lot about it because, quite frankly, you could say, well, is Voya Investment Management in the crosshairs of acquisitions? Because, we're right about 35 billion of assets. However, we do have the blessing of being associated with a very powerful parent with a retirement business and asset gathering. So the way I view Voya is we have a place to play, in an industry that is becoming more and more commoditized. And so, but also an industry where there are tremendous cross pressures, both from the regulatory and the fee side. So really thinking about, what do asset managers need to do to succeed in the path forward? Well, number one, you have to be realistic to say, does my business model work? I know that sounds hard. More and more are actually kind of realizing not, and they want to be acquired. But of course, they want to be acquired with all of them still having their jobs and being completely left alone. It's like, well, that doesn't necessarily work. So that type of thing. So we'll continue to see consolidation. So really figuring out where you're going to play and being very vigilant on analytics, robotics, efficiencies, and being willing also to kind of strategically make some difficult people and alignment decisions over time to really make sure that that you're hungry, you're nimble, and you're ready to move forward into the future.
So I think that's a really interesting perspective. And as you think about, again, various strategies your firm is offering and, again, the broader landscape within the industry, what do you think are some of the best opportunities for clients to invest in right now, and why is that? We're in an interesting inflection point. Just generically, I would say that sort of the view is that the global economy is continuing to strengthen, earnings growth, et cetera. So even though we have a lot of clients very worried about, and love to hear Lisa's view, how many times do you get asked, where are we in the credit cycle? When's it going to end, right? It's like the patent question. So sort of the house view for beta globally is that it still has a way to run. Global equities are attractive to US, and equities are attractive to fixed income investments. Now, going to where our capabilities are and more of my knowledge of fixed income, however, is, wow, I mean, fixed income, the margin for error is very low. And so when you think about QE ending and not priced into the market really is the conversation around the ECB ending QE. I think the fixed income is going to be in this inflection point where it's got duration risk and more volatility. So it could be a little tougher in fixed income, but you can't run and hide. So in terms of what we do that are some of those customized opportunities that we still like, idiosyncratic opportunities in real estate and securitized credit, as well as a strategic investor. We do a lot in private credit, we call it, which essentially is less liquid, but has lots of covenants and protection associated with it. So to the degree you are worrying that you're going to have like more global risks and you want protection, having some form of covenant to still play in credit, but maybe survive a little bit better when the world ends, we just don't know when, is a good thing. So Lisa, teeing off of some of Kristine's comments, particularly around QE and corporate credit, has the market, in your viewpoint, has the market been a beneficiary of QE, and what will happen when central bank balance sheets contract?
That's the trillion-dollar question, right? I mean, that's been the thing we keep debating within our team quite a bit. So, if I think about the credit cycle and where we are, I think we're very much in the final ending points of the credit cycle when you look at things like leverage. We haven't seen leverage for at least investment grade credit with these kind of metrics since 2002. And for those of you who remember what 2002 was like, that was a period that was a little bit rocky. You had WorldCom, Enron, et cetera. And when you look at valuations, where we are today, we're really back to pretty much the all-time tights, particularly if you adjust for a deterioration in credit quality. I feel like I'm missing this part of the audience. I'm just going to turn my chair a little bit. Particularly when you look at credit quality and you look at the duration of the market. So, where does QE come into the picture? And I think we have been a beneficiary considerably. So when you look at flows in the US market alone, if I told you that this year was the second highest year for mutual fund flows into high-grade credit in the past 8 years, you'd say, how is that possible given where we are in the cycle? It doesn't seem to make sense. Or when you look at European fixed income flows, particularly into mutual fund space, again, flows this year are 3 times what they were last year. Well, why is that? It's still the tail end of QE that is driving investors to find homes and to find yield. So, when I think about, where are some of the inflection points? What would I look for? Well, we talked about, QE phasing out over time. We think about QE on a global basis. So to us, the inflection point is going to come sometime in the summer of next year when globally QE starts to no longer be a positive contributor to our market. And finally, central bank balance sheets begin to shrink. And the things that I would keep my eye on to see if we're near the end of things is to look at some of the foreign flows. So in the US, foreign flows are now about 25% of the holdings in the investment grade corporate market. A lot of that comes from Japan. So what I'd be looking at is, can a Japanese investor still come to the US market and buy corporate bonds, hedge them back to yen, and still do better than what they can earn in their domestic market? I would look at the European investor. No longer are they getting paid 0 or even earning a negative yield, so to speak. When that starts to change and it no longer makes sense for them to come to the US market and hedge it back into euros, then that's when we start to see QE impact and the unwind of it really start to create some speed bumps for us, at least in investment grade corporates.
So I know that you mentioned there's a number of investors that are still seeking yield, obviously in this type of environment. And I think as both of you have mentioned, the corporate market is obviously appearing to be fully valued. So where are you seeing opportunities? Do you agree or do you disagree with Kristine in terms of illiquid's a good opportunity set given the current environment?
So I have kind of a hybrid answer to this, and I agree. I think you've got to look for pockets of value. So a favorite of mine for many years has been European banks, and maybe we were a little bit too early at different points in time, but that to me is just a really interesting opportunity. You've got growth in Europe looking pretty good, 2.25%, let's say, for this period of time, looking forward. You look at what European banks have done with their balance sheets and what they've done with capital. So if we look at a measure like CET1 ratios or core capital for banks, the ones we look at, it's averaging about just under 15%. So from a point of view of a credit investor, it's actually a pretty good time to look at the banks. Oh, and I should also mention that their non-performing loans are continuing to come down. So the way we've approached it is, if you feel comfortable with the fundamentals of these institutions, come down in capital structure. Mm-hmm. So a bit of a controversial investment, but something called a COCO or an AT1. Everyone's like, oh my gosh. But again, these are similar to the preferreds market, which many of you are familiar with here in the US. They just have explicit write-down language. But given that you've got these very high levels of capital, you've got a very big cushion before you can even contemplate a write-down. So that's where we're finding value, 5-6%. That looks pretty good to me in fixed income.
Great. Laurie, I think I'm going to move over to you, and I would love to hear some of the current research projects your team is working on. I know that you had mentioned in part of our correspondence you're working on a big project around European money market reform. So I'd just like to hear again about some of the work you all are undertaking at this point in time and how that impacts.
Yeah, well, I will tell you, we have been living, eating, and breathing, all of us, reform since the financial crisis, and we've made sure that we've had a seat at the table because we know what the regulators are trying to get at, whether they're trying to make money funds safer and more resilient, but also have the regulations impacted the securities that we buy, the repos, the tri-party repo business, and then obviously also the issuers, the banks. The front end of the curve, 80% of our issuance is financial. So we look very closely at the banks. They're big issuers of ours. And so now we've gone through the U.S. money fund reform. That was this time last year. So we still have some little tweaking to do from that perspective, because clients in the U.S. had to really rethink about what kind of funds were they using for their cash here in the U.S. And now we're also enjoying positive interest rates, which is not that we were negative, but again, upward sloping, so it's nice having a one handle. So turning the attention to Europe, we finally just got the money fund reform rules this past June from the regulators over there. There's still some details to be worked out. We're waiting for ESMA to come back with some finals, but it's going to be a big project. We can piggyback off of the work that we did here in the U.S. But right now, we're just reaching out to clients, talking to them about, here's what the landscape's going to look like, here's your investment options, and if they are global investors where they may be in U.S. and European money fund reform, what are the differences? And it would be terrific if the regulators had really been on point and made it consistent globally, but of course, there's nuances. So, it's not as easy a discussion as you would think. But it's going to be a big project. It's going to impact every component of what we do, from trade execution all the way through to what information clients get and how do we talk to them. So it has to be done by January of 2019. So it's a big project for the upcoming year. A lot of trips to London, which is not a bad thing. It's a great city, but it's a good opportunity, and that's how we're looking at it. A lot of people through the U.S. money fund reform said, do we really want to be in this business? The regulations, it's expensive, it's time consuming. We had like over 150 people at Invesco globally working on the U.S. money fund reform, and so that's quite a task. So there's going to be a lot of money in motion. We're looking at it as an opportunity, because anytime there is that dynamic in the market, it's an opportunity to hopefully take some and earn some market share in the business. So,
Thank you.
Yeah, absolutely.
So Maria, kind of this seems again like a natural launching point to talk a little bit more broadly in terms of scope as it relates to emerging markets. We've seen some really strong performance out of emerging markets in the past trailing plus year or so. In your viewpoint, how has the geopolitical landscape influenced results, and how does that impact your specific outlook as it relates to your team and execution?
Yes, I think when we look at the geopolitical environment in which we live today, certainly it's not benign for emerging markets. Even at the beginning of this year, when people were talking about, the conversation was about what you're talking about, when is the Fed tightening, liquidity is getting hard. That is usually not a good environment for emerging markets. And if you put it on top of that, the Korea's crisis, all what is happening geopolitically, these are environments that traditionally have been very scary for emerging markets. But in a way, I welcome it. Because what this type of very sort of skeptical environment around emerging market, what it has created is this conscious by the corporates, which is what we look at, to say, well, we no longer have the wind on our backs. We no longer have free money coming to us. We no longer have sort of the global markets coming to the rescue, the whole globalization was even being put in question, global trade, all these things that are fundamental, historically have been fundamental to the EM story. So what this creates on the psyche of the corporates is more of a self-help story, is what I call. They say, well, we no longer have all these avenues available to us. No longer I can leverage myself to be the largest mining company in the world, the largest whatever you want it to be. So we have to go back to the discipline. Let's focus on profitability. Almost take a page of what has happened with the U.S. corporates and say, well, we no longer can rely on just being emerging markets and capture the dream of the EM story, a lot of growth. We need to be profitable in the process. And what you have seen and the reaction of the corporates, in my mind, very positively. A lot of divestitures, rapid deleverage, things of the nature that are very unlike EM companies, going and reducing capex, really refocusing on being smaller and more profitably. And this is very benign. I think this reemergence of earnings at the center of EM story rather than top-line growth is something that we welcome from our perspective of being very bottom-up. Yes, the macro environment will continue to be somehow hostile, but this will kind of almost force the hand of the corporates and the players in emerging markets to be more really careful and more forward-looking in the sense of let's protect what we have. Let's focus on what is the business that we're really good at. Let's focus on let's divest the non-core, divest what we're not good at, and refocus on what we're good at. And this is going to provide what in our mind is a much better, more sustainable story for emerging markets going forward. Is this going to mean that there are not going to be global events that are going to hit emerging markets? No, but the corporates will be better prepared. The financial architecture of emerging markets will be more solid in an environment whenever the liquidity completely sort of dries away. Whenever we have these incidents in geopoliticals hit the asset class, you're going to have a much better prepared domestic story within these markets. And I think that is something that we welcome.
Correct. So as we're witnessing improved financials and corporate oversight within emerging market companies, within the US, obviously US equities have done very well since the financial crisis, and there's been a lot of discussion again in terms of valuations and outlook within the US marketplace. Margaret, so in your viewpoint, what do you think are the biggest risks today to US equities, and how are you and your team positioning and navigating that current opportunity set?
So in terms of large cap U.S. equities, no question. I mean, the market has been amazingly complacent with respect to all of the risks that we see. I mean, every time I'll see headlines, and I remember a year ago when we saw the Brexit vote, and the market was down, 300 points the next day.
Margaret,
and if we had
if
we had the Brexit vote today, I bet the market would be flat because we've had several things that have been as big in terms of news, and the market seems to be very complacent in terms of factoring in that risk. I agree with both of you that I think that we're at the later stages of the economic cycle in the U.S., but before you sell everything and go to cash, keep in mind that later stages have historically lasted 3 years, and we're probably a year in. So we have some time to go, and it's really hard to predict what's going to be the thing that is the catalyst that pushes us over the edge. But I think it's too early to go to cash. I think the way we think about it is understanding that and understanding that GDP growth in the U.S. is still fine, the PMI numbers are fine, ISM numbers are fine. Think about risk and think about diversification and think about making sure that you are nicely diversified, that you don't own too many really expensive consumer staples because everyone's looking for yield in the equity markets, or that you don't own too much large cap tech, which has been the key driver to the market. So when we think about where we're going now and what we've been investing in, specifically within tech, I would say we're going down the market cap chain, because it's really hard to argue that Microsoft at 22 times when they're probably over the next 5 years going to grow in line with the overall market is going to 25 times. That's a hard argument to make. But mid-cap tech, you can find some really great opportunities that stocks have still been flat year over year in the context of tech, which is up 25%. So that's one area that we think is still really interesting. And the other area is biotech, which has still... It's up year to date, but it's still dramatically underperformed technology, and I think people are missing the boat. I mean, I firmly believe that while I appreciate all the concerns about drug pricing, companies that create drugs that cure unmet needs will get a return on it because they're gonna save lives and they're gonna keep people out of the hospital. So, we've spent a lot of time thinking about, where are the companies that are really not taking price but creating volume growth and have big pipelines for innovation? I mean, Celgene is a great example, just as a context, because Celgene they're growing 20%. They have 20 phase 3 clinical readouts. They've got $5 or $6 billion in free cash flow every year. Very nice balance sheet. And the stock's trading at 15 times, discount to the market. I mean, if you put Celgene.com, it would be trading at 22 times. So, there's a big mean reversion trade there, I think, which is still interesting. Mm-hmm. The other thing that I would just say in terms of risks and what worries us, it gets back to large cap tech, because I think in some ways the risk that worries me over the next 5 years in the market is regulatory. I mean, the mega cap tech names have so much data, information, power, reach, et cetera, that I'm not exactly sure how it's going to happen, but I do see, even versus 6 months ago, an increasing number of headlines of, wow, Facebook had Russian ads, or, Amazon may have drones, and do we really want the privacy, or how is Google mining your data in ways that you may not actually know or want to happen. So I think that all of those things concern me a little bit, because I think it may put a damper on their ability to grow going forward. And so that's something that I think would have big implications for the overall market, just because they're so big as a % of the indices.
Thank you for that perspective. I'm sure a lot of you have burning questions right now for a number of our panelists with respect to some of their views and thoughts, but if you don't mind, we're going to hold questions to the end. So if you have any questions, please feel free to write them down, and we'll make sure to address them in a little bit. Now that we've spent a little bit of time talking about kind of your current views and how they impact your overall investment strategies respectively, we thought it might make sense to pivot a bit to really talk about what drew you into finance initially, and talk a little bit about the WIM initiative, particularly the CFA Institute initiative around women in investment management, but not only that, but more broadly to, again, surrounding the topic around diversity and how more diverse teams, people with different experiences, collectively contribute to better outcomes. So with that, Lisa, I wanted to start with you and just get your thoughts on what brought you into finance initially, and what really motivated you to stay within the industry as long as you have?
I could be really honest, it was almost accidental. I graduated from college with a degree in economics, and I can remember somebody said to me, oh, you should go work on Wall Street. They have this thing called sales and trading, and that sounds really exciting. So, here I was, I start doing these interviews, and I can remember just not getting anywhere. And it's my personal story. I remember getting the feedback that you're just not tough enough to be a trader, which for anyone who knows me might find that somewhat surprising. So I found it a challenge. And I remember getting introduced to a gentleman named Maury Harris. And I really should look him up again, because this goes way back. And he said, I was at the Federal Reserve. That seems like a nice place for you to go. I'd be happy to give your resume to someone. And so my first job was at the Federal Reserve. And from there, I developed an interest in international. I went back to graduate school at Columbia in the School of International Affairs, not the business school. And I was lucky enough to get a job as a research analyst. And it was at Travelers. And my area to cover was, and this was back in the 80s, Canadian provincials, Japanese banks, and French banks, which seemed a bit of a random assortment. But it actually proved to be pretty interesting, because it wasn't too many years after I was covering those that the Japanese banks started to run into a lot of difficulty. So I felt like I had a little bit of a window of insight into that. So anyway, that's how I kind of ended up there. It was really, to be honest, kind of random. But it's been just a great opportunity. And what I think is, and I'll take this perspective from a women's point of view, what I like about being a portfolio manager is you are measured objectively. The numbers are the numbers. Nobody can say, oh, well, what about this, what about that? They have your performance. You get your performance every single day, and you know how you're doing. And so I think that was a great equalizer for me in my career at times when maybe it didn't feel quite as equal as it is today.
Mm-hmm. And why do you think finance is such a great place for women to work? And I open that up to all panelists, because we're obviously, I think you are all here today because you're passionate about the work that you do. And so what's really, again, excited you about staying within your field and your line of work?
I mean, a couple things. I love it because every day is different. When I wake up in the morning, I was in London on the day of the Brexit vote. Nobody expected the vote to go the way it was. And you immediately have to react and think about your view, and is your view correct? And if it's not, what do you want to do? So I think there's this constant challenge. And I love the fact that every day I get to compete with people like these women that I'm on this panel with, who are so bright and so talented at what they do. And it can be a very rewarding experience when you're right, and a very humbling experience when you're not right. And then I would say, again, taking more of a women's perspective, I think the pay is very good. If you do your job well, the money is good. So that's a motivator.
I would agree. I would absolutely agree with you because, this business keeps you on your toes. Every day is a new day. And I remember at one point I left the global liquidity team and I went and managed, no offense to people that manage, mortgages, but I went to manage the mortgage portfolio. And that's when I decided to start studying for my CFA because I was getting bored, because I had a view on the market. We went forth, we executed it, and I was used to the liquidity background where every day, billions move in and out, and it's just always changing. And so it's a great opportunity. It keeps you fresh. And I think the asset management industry is incredible for anybody, but I think also in particular for women because there's so many ways that you can enter into this business. You can go in through the investment side. You can be in legal compliance. And trust me, with the regulatory background, they're still hiring probably, on the regulatory side. Sales and marketing. So no matter what your strength is, whether you're male or female, you can find a home in this business.
I would also add, I think the work-life balance is awesome. I mean, it's not about logging in more hours does not give you good performance, right? I mean, if you can come up with a good idea just on Mondays, that's great. And I think that's really important that this is not a show, a FaceTime business. It's a performance business. To your point, you're good or you're not. I mean, I always say internally, like, if I'm good, I should be paid. If I'm not, I should be fired. And I think that's fair, right? And I applaud that. So I think work-life balance is very good in this industry.
Well, thank you. Maria, I'm curious, you and I had lunch yesterday and we were chatting a little bit about your background and experience, and you made some interesting comments, so I wanted to try and tease that out of you again today. But you began your career in Bogota, Colombia as a foreign exchange trader, and I'm curious how your path led you to the US. And then as a follow-on to that, how do we kind of think more broadly as an industry about continuing developing financial opportunities both within the US and outside of the US? And what do you think the industry might look like in a few years?
Yes, I'm Colombian born. I went to school in Colombia, undergrad school, and I first came to the US to go to Columbia Business School. And with the intention...
Because you thought you were so good.
Yeah, keep you straight. So the path that I had in mind, really very accidental. I wanted to go back to Colombia to work in the central bank or something like that. And then at Columbia University, I discovered this industry that I sort of felt it was like, this is the best. I mean, all the qualities that you described, the balance that it offers you, the fact that it connects you to the world in a way that is very tangible, the fact that our awareness of what's happening in the world, politics, socially, in every aspect is something that we live in every day, that we are connected to in a very direct way, is something that fascinated me. But when I look at, when you look at CFA, for example, we know there is a challenge of women participation, but it's a tremendous influx of the international. The international growth is tremendous in CFA, in applicants, in people taking the exam. And I had the opportunity to be the judge of one of the stock picking contests from all the main business schools. They have, I think Harvard or Cornell organizes it in Boston, and it's all the Women Investment Management Club, that, by the way, they didn't exist when I went to Columbia Business School, but now all the schools have a Women Investment Management Club, and they all send their best team, I guess, to represent the university and compete for who has the best stock pitch. The demographics of those clubs, of all the contestants, all very bright women, was overwhelmingly international. That was sort of very interesting to me. I was an international student that came here, that sort of became an American and started working. I think when I look at all these female investment professionals in the future, all really the composition of those teams was very interesting to me. And I think what that tells to me is perhaps the stereotype that women in emerging markets, a lot of EM women, by the way, in those teams, a lot of China, a lot of India, a lot of Russia. Those were like the compositions of the team participants. It makes me think about my experience when I travel to these places. I come across to a lot of people across the chair with us, with CFOs that are women, CEOs that are women, in these places where we invest. And that really makes me very hopeful about the future of this industry. Yes, we know we're not where we want to be in terms of participation, but the fact that this tremendous growth is happening outside of the US, and among this growth, the female are participating in such an active way, is something that I find very encouraging. And why are these sort of, perhaps because these industries in these other parts of the world have not been developed to the level that the US has been developed, there is not this legacy. There is not this is the way it is, and you have to break into. This is all young, this is all new. And all these ladies that are gonna be graduating, some of them are gonna be going back to China, back to India, out of these places, to develop what is a very interesting like investment management organization and structure in these parts of the world. So I tend to look at this with a lot of optimism. I don't think of the past and these are the barriers. Certainly they have been, and it's not to debate that. But looking forward, I think it's very encouraging to see sort of what is happening, the growth that is happening in outside of the US in the investment management industry, and the role of sort of female participation. So that makes me very hopeful.
Laurie, I'm curious about your perspective on, we've heard some of the stats earlier today from Marianne in terms of low number of women charter holders globally. I think that number is roughly around 20%. I know Marianne will correct me wherever she's at. And that number's been fairly stagnant for a period of time. I think it's been the last 5 or 10 years. There's been no really uptick or growth, even though to Maria's point, you are seeing increased international interest in pursuing a charter. So why do you think that is, and why do you think that that number remains so low, not only within the US, but globally?
Well, I think just kind of focusing a little bit on the US, one of the things that I've noticed, I think we have a bit of a PR problem if you really want to know the truth. I mean, it was really encouraging to hear say, this is great work-life balance, in this business. And, I've got 2 daughters, one's graduated, one's in college. Neither of them wanted to be in the business. And I would ask some of their friends, and I was like, that are in finance, majoring in finance or accounting, I was like, do you have an interest in investment management, the asset management business? And they were like, no, because they feel like there is no work-life balance. They feel like there's a lot of obstacles there. So, I feel like we've got a bit of a PR problem if you really want to know the truth. We need to get out there and change perceptions. And women are tremendous investors. Like you said, every day we come in, we see our performance. I did see, I think it was Ignites or Ignite Europe had an article, and there's actually, a hedge fund index that tracks the performance of female portfolio managers, and they're outperforming the men year to date, And so I think we just have to actually get out there and remind people that, women, number one, you've got quite a big purse, if you will. We're big consumers, big users. Let's look at putting that towards, investment products. I think that's number one. We're good consumers, we're astute investors, and we need to participate in this business better. So I really think it's almost going out and educating young women about the opportunities. And one of the things, too, when we talk about the universities, again, we can even start earlier than that. Think of all the STEM, the science, technology, engineering, math. We're starting to see that work in the schools. You see commercials even on TV now. I don't know if you guys have seen some of the cute TVs about women in engineering, and I feel like, well, we need that for investment management. We need to pull them in and remind them this is a good industry, and I think you can, like I said, there's a lot of different pockets where you can find a home in this business.
Yeah, and I would just want to add one thing on to what Laurie said as well. As I went to the Kelley Business School, and I went back and I tried to really figure this out, because what the problem is that you don't even get the women into the business school, let alone the business school women mostly are not going into finance. And so you got to go to high school. Right, that's where you're going to change the needle. And what do we have coming out of the financial crisis? Women view us as greedy, as misaligned, as non-teamwork oriented, where you're hungry and you just want, look at the people that they see, whether they've been indicted from the SEC, you see even, just different institutions having morale kind of challenges, right? Yeah. And so our industry has a bad reputation, and I think particularly for women, they're like, quality of life. They don't really understand it. And they're like, I don't want to be a part of this.
Yeah.
And so it really is incumbent upon us to get out and say, you don't have to be, they're also nervous about being good at math. And I'm like, guys, you know,
I know.
it's okay. I'm actually not that good at math, and I did mortgage derivatives for a living. So no, that's scary.
what systems are for.
Yeah, that's what systems are for. But again, it's like there are a lot of rich career opportunities. The pay is very, you know, competitive, and the quality of life is really good. So again, I don't know how we do it because it takes time and energy, but we got to get into the high schools, our firms with programs, tell our story, mentor them early, and really try to change, because it hasn't gotten any better in my whole career, and I've been doing this over 30 years. I think we actually have gotten worse in terms of the number of women, you know, in the inside that are actually coming in to join our industry.
And then that number's even smaller too, right? Once you look at actual portfolio managers. I mean, in your collective viewpoint, what do you think are the obstacles to women, again, staying within the industry, but then also pursuing a career in portfolio management and actually getting elevated to that level where they're actually, you know, running a team and managing their own strategy? Just curious on your viewpoints there.
Oh, to me?
Yeah, for anyone that would like to answer.
Well, you know, boy, I could go on for hours about this. I think a lot of it is unconscious biases, and I'm actually been really thinking about it and researching it. Like even the words that women are ascribed, or they may use to describe women as teamwork, listener, supportive, and men it's like, oh, you know, there's actually research that even on reviews in corporate America, you can Google this. Harvard Business School has really rich statistics on this, that reviews will say the man achieved this specific project or this specific outcome, and the woman, it's all about, well, look what the team did. And so I think we just have to be really aware ourselves as leaders, you know, what are we doing? Are we giving the women stretch opportunities and challenges? And there is something about it, and you know, not to use an overquoted book, Lean In, by Sheryl Sandberg, but there was a really powerful chapter, I read it, and it's all about that women won't sit at the table. There's a whole chapter, if you haven't read the book, where she observed that the younger women were intimidated in the conference rooms, and the men would boldly go in and sit down. And I've had that as a trigger, and I've watched it, and it happens. And I've actually then now mentored women in the moment. We all need to do that. Hey, do you realize you need to sit at the table and you have a voice to be heard? And as a portfolio manager, you got to have a well thought out opinion, and you got to be bold about saying it. You can't sit in the back aisle. So I just think that they're not getting the reinforcing messages that they need to, that they're smart and they're self-confident and they get talked over. Do you know how many meetings, even to this day? I mean, I'm on this thing called TBAC. It is a nightmare. It's this Treasury Borrowing Advisory Committee. And so imagine all of these testosterone-oriented men from Wall Street in a room advising the Treasury. I get talked over. I'm the CEO of Voya Investment Management, for crying out loud. I even will sit in meetings, you know, it's just crazy. So again, I'm just telling you this, that I don't know that men are always conscious about sort of the subtle signals that they send to women to say your opinion doesn't matter. And so for us as women leaders to be a little bit more sensitive about that, to foster and encourage and mentor to make sure that doesn't happen.
Can I hop in here, because I heard a great story the other day. I was in London a couple weeks ago, and I was asked to speak. We have a thing called Wi-Fi, Women in Fixed Income, and we have a London group. So I was asked to speak with them. And I heard something really interesting. So apparently, during the Obama administration, there were a number of women who felt their voices weren't getting heard. So what they decided they would do is when one would speak, and somebody might speak over them, another one would say, you know, Kristine, that's a really good point. I was thinking the same thing. And it occurred to me that if we started to do that more, and men can do this too, it's not just women, it really helps to amplify your voices. So you got to find somebody on that committee who's going to say, Kristine, good luck with that.
Great thought. That's a great thought. No, I hear you. And now what I do is I just keep talking, because I got I got that advice early on, is that somebody's actually going to realize who's interrupting whom if you just keep going. So that's my strategy. As you, like you, I'm not exactly shy.
And I think, so we've been talking a little bit about some of the challenges around women, but I think more broadly too, as we think about the recruiting effort for asset management, what are some of your thoughts? Again, and I throw this open to Laurie and the rest of the panel, but some have said that there's not really a formal route into asset management and that internships are becoming more scarce. So what are your thoughts around providing access to individuals early on? And I know there's been a few comments around getting into business schools early on, educating, providing perspective. But outside of that, how do we provide access to individuals early in their careers and then also directly shape their development kind of as they grow within their career?
Well, I know at Invesco, we're actually focusing on rolling out more internships this year than ever before. And, we've effectively been given a 50% mandate to try to get more women into that internship because we have to start building a bench. You have to start building a pipeline, and that's a great place to start. Right now, we don't have an initiative to go back as far as high school. I think that's what we have to do. I think just through volunteer efforts, just more generally, but just trying to build up, number one, the internship program. The other thing too is making sure that we're hiring more entry-level people and providing mentorship for them. There's more formal mentorship programs that are being rolled out actually offshore in London and Hong Kong right now. Our Women's Initiative, we have a mentorship program within that they're going to then transition some of this over to the U.S. to try to keep people also in the firm and mentor them, like you said, real time, what are some things that are going on that you're doing just in meetings and how to do that. And obviously working with the universities, the Forte Foundation, Girls Who Invest and other things like that. We're just looking at trying to cast a pretty wide net here and see what starts to take. I know specifically for us, I don't know if there's similar experiences.
We're doing the same thing. I mean, I think ClearBridge is, we have a couple female portfolio managers at the firm, but it has been a big focus for us. And I tell you, I started 3 years ago having a female intern every summer, and the only criteria that I asked for was, I want someone who is intellectually curious, and I want someone who doesn't know anything about Wall Street. Because I think that's the point, is you want to get that person who said, ugh, too hard, too scary, too many mean men and women, I'm not interested, and show them that it can be a great job and a great career. And I'm so proud because I have a little Vitrano babies all over Wall Street now, because I've had 3, and 2 are now at Morgan Stanley in capital markets and investment banking, and a 3rd is somewhere else on Wall Street in investment banking. So it makes me so proud that they did a summer and they decided while they weren't going to do Wall Street, now they want to do Wall Street. And I think if you just keep doing that, it's slow, but I think that's the process. It has to be show them what it is, and convince people that it can be really, really rewarding.
I'm glad you said that, because one of the experiences that we had probably about 10 years ago, we were having these interns, and you're just looking at these resumes, male and female, and they're just impressive. And some of these kids came in and they had no work ethic. I remember there was a World Cup, and I started realizing this guy's watching TV. I was like, no, that's not the way we're doing this. So I love the fact that you said knows nothing about Wall Street, because I think at the end of the day, you just want somebody, like you said, that's curious, that has a good work ethic. That can solve a lot of problems right there.
Well, we've been talking a little bit about recruitment and retainment, and so I want to transition over to kind of construction of high-performing teams. And obviously, this is an investment panel, so it'll be slanted towards construction of investment teams. And so, Kristine, I'll start with you, but as you think about building out your investment teams, how do you really assess composition, different skill sets and personalities in order to find kind of that magic formula as you're developing new strategies and products?
Well, one of the things we do, and we take diversity of thought to a whole nother level that we started, is we actually take these personality tests, like biases, called Enneagrams, and I have people smiling because Voya Investment Management does this, but the reason is it sort of divides you into 9 personality sort of preferences, if you will. It's much richer than Myers-Briggs, and it really gets into how do you solve problems, how do you react under conflict. And so one of the things that can happen is in an investment management team that's critical is how do you manage it when things aren't going your way? right? It's really great when your performance is top quartile and, but when it's not, I mean, that's when the problems start. And so understanding, number one, do people have diverse perspectives? Understanding how they deal with stress and conflict so you don't take it so personally and jump to judgment, because there's nothing worse than finger pointing of like, well, I told you that, China was blah, 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 or whatever. I mean, fill in the blank. So I think, definitely diversity of thought, but that chemistry, to try to get debate. And one thing that I've learned in my career that's interesting just to share from a perspective of being a woman is I always had to sort of be the smartest person in the room. And I don't know if that resonates with you, right? But, just like to have the good idea and stuff. And I learned as a leader that is a mistake, particularly when you're running the company, is to try to sort of speak last. Because to be very aware for all of us, right, we're all very senior, is also to just sort of not have ranks and to be very mindful that you speak last so that people don't feel like groupthink, like, oh, well, the boss thinks X, therefore I'm a little worried. It's just being very cognizant of that safety with the investment debate's critical.
And we observe that on a number of boards and investment committees. If you have the more senior person in the room that comes in and projects their opinion, you can immediately see how that discussion is going to go and what decisions will likely be made as a result. So I think, some of the things you mentioned as you're thinking about composition of teams was debate, chemistry, again, problem solving. I think, again, for the rest of the panelists, in your perspective or from your viewpoint, what do you think are other characteristics that will ultimately lead to success? Again, as you think about that overall team equation.
I will add to the debate is heavily, especially in investment management, people talk a lot about the debate, and it's almost the notion that you have this stock and they're going to have to be two opposite views to develop a view on a stock. I would offer an alternative in a way, and I think my team is mostly female, so perhaps for that reason it develops like this. Dialogue gets you there as well. Very intense dialogue. Like, we're going to discuss the stock today, and the notion that out of this room, we're going to decide who wins and who loses. It's not something that I think necessarily generates the best outcome. I think that intensity of dialogue and discussion among the team members is something that can generate a more sustainable outcome in a way, something that has more of all these elements, all the parts of the ideas, all the potential risk and opportunity that are that dialogue can be fostered and can create a very positive outcome. So teams that have that capacity to take and retake and have other people input into that are very important. And I guess to kind of not necessarily in opposition to the conflict, but I think perhaps as a way to say, well, not sort of elevate conflict to be the reason. And I think in that sense, perhaps a women team will be less inclined to this head-on confrontation. So an alternative to that is like a dialogue that permits all different points of view to be added to the discussion. That is an alternative can lend itself to very good decision-making as well.
One of the things that's been interesting for me, I was speaking earlier about this, my team is kind of interesting because I'm the oldest person on the team, but then there's a gap, and I've got a number of people who are kind of the next level down, age-wise, but also seniority-wise, and then I've got a lot of very young people on the team. And one of the things that we try to do is to make sure that everybody comes up with an idea. And what I found really interesting is some of the more unseasoned people actually have some really great investment ideas. And we've got to get people open to listening to them and taking their opinions with the same level of importance as somebody who might be a more seasoned investment professional. So it's being able to think outside of the box a little bit.
So I'm hearing a common theme here around the importance of communication, which I am a strong advocate of with my own internal colleagues and clients. But I think as you guys think about communication being incredibly critical to the ongoing debate and dialogue and process, what other unique perspectives or skills do you think women bring to this investment profession and then also portfolio management? And when I say portfolio management, I'm also talking about kind of those key roles that support that overall process, such as analysts, et cetera.
maybe I'll start with that. You know, we were talking about before we came out, and I do believe that women portfolio managers think about risk differently. It's not better or worse, but it's different. And I think that my partner is a male, and so that does lead to dialogue or debate, depending on the day. But it helps us, we think about things absolutely differently. Something that he thinks is very risky, I think is not risky at all. And so it's very interesting to me to sometimes see something that he thinks he would be very comfortable having a 10% position in one stock that he feels good about, because he feels very confident in that one stock, and that's great. And to me, I think, oh my God, 10% of our entire portfolio in one stock. You know, I'm not smart enough to know all of the unforeseen things that can happen that would change that profile. That's way too risky. And so just having we have absolutely a different risk profile. And I also think that perhaps it's my insecurity, but I'm always retesting my thesis. I'm always a little insecure about everything that I'm invested in, trying to say, wait, I think I really like this stock, but let me just double check this, and let's think through this other risk and make sure that that's not real. And it's that constant retesting of the thesis, which ultimately leads to, I think, more of a willingness to admit that you're wrong and sell your losers. And that's what we were talking about before the panel was, you know, that is one of the biggest mistakes as an investor, is being too ornery about your buy, that you're not willing to say, you know what, I was wrong, let's sell. And so I think that insecurity has been really helpful for me.
I think I agree with that. It's a tendency to do the homework and do it again. But I think for when you're developing young analysts, the diligence is superb. They will do the homework. They will be extra prepared. They want every angle. At some point, that risk-taking, that step, you have to jump. Mm-hmm. You're not here to support another analyst. You're not here to kind of give me, like I travel the world and the analysts will write me by recommendations. That's not useful to the stocks, to the ideas that I like. They have to generate their own idea. And they have to, yes, it's very good that they're very diligent, that the homework is done. But the final step, to ultimately become a portfolio manager, to ultimately be in this panel, you have to believe and take the risk. And I think that is something that, I don't know how you teach it, it has to start from the beginning, but you need to have the risk-taking initiative. That ultimately is a risk, because, you know, we don't know the outcome of any of this investment. People will say it's a random walk. No, we need to have the confidence on what we have, the homework we have done, and sort of encourage them or have that ability to take that step, and that is very, very important for young professionals. Otherwise, they will be filling the blanks for somebody else's work, and that is really not what you want in your career.
Yeah, and one thing to add, the liquidity business is a little bit different, just in terms of sometimes, depending on the currency and, you know, where your focus is, sometimes we trade by appointment. You know, we can be a victim of supply, if you will. You know, you may have the best thesis and you want to go out and execute that in your portfolio, but the supply just does not cooperate. And the liquidity business, we're very rules driven. And so one thing that I find that the women kind of bring to the table is the ability to multitask, because not only do you have to take this overarching, all these rules that kind of run money market funds, have that, overlay it with the investment parameters, the liquidity, and then, by the way, you're having T0 flows at the same time, and you're constantly moving and rethinking your thesis every single day. You have to be a good multitasker, and because depending on the firm, because there's two different ways to structure it, but at Invesco, our portfolio managers are also traders, and I think too, just that component of the relationship part of our business, when you are trading by appointment, you need to make sure that the street likes you, they know you, they want to work with you, because it's a lot of moving part, and I think that relationship component of what we bring to the business is also really helpful. So it's a little bit of a different view, kind of in that T0 environment, and that's what I think too. When you look at the team, you know, I think the women on the team are more intuitive in terms of, and also more willing to change as the flows start changing and the market changes intraday. It's not just, gee, what did we do today? Let's look at it tomorrow, revisit it. It's like, what was my plan this morning? Okay, it was different now it's different at 10 and it's different at 5 p.m. And you have to be that flexible because it changes that quickly. So that's a different kind of view on the team building component.
Well, Margaret, I think your comments around risk are spot on, and it's interesting how you stated, I think that we view and we execute risk differently, and that's obviously been borne out in a number of research periodicals stating that women investors are typically known for a higher unit of return per level of risk, and that's absolutely why all of you are here today, due to your achievements within that space and on that metric. So I think, again, as we kind of close the discussion around diversity and building out teams and continuing to foster growth within the industry, Margaret, I'll start with you, but what type of change are you really promoting within ClearBridge and more broadly within the industry? And that could be around hiring practices. I know you talked a little bit about some of the internships you're an advocate of, but other types of, again, organizations or affiliations or any other activities you strongly support?
I would say two things. Within the organization, I think I'm known for being direct. and so, we do 6-month reviews on all of the analysts. But I actually call the analysts in and give them the verbal feedback, because a lot of the portfolio managers give these anonymous reviews so that I can rate Kristine and say something about her, but she doesn't actually know it was me that wrote that, which I don't think is very constructive. I think it's much better if I say, Kristine, here's what I wrote, here's what I think, and this is how we can have a dialogue, and you can be more helpful to me and you can improve. And so, I try to do that, because I think, look, I was an analyst too. I actually started off as a secretary. And so I think that you have to have people who give you the honest feedback to help you become a better person and become a better employee, improve your career path. So I think that's really important. The other thing that I would say is, it's interesting, because Morgan Stanley has this women's investor forum every year, not the one I was talking about before, but one that Jim Gorman and Ruth Porat used to do. And I remember one time somebody was saying, well, how come there aren't enough women on boards? And he said something that I thought was really interesting. He said, well, look, experience begets experience. And I asked our board, the board of Morgan Stanley, that, and some of the folks that were deciding who would be nominated to be on the board. And what they said was, look, Jim, it's much easier for us to find you a low-risk board member who's already been on 5 other boards, so they're very experienced. Nobody's going to balk at them. I can bring you a female, but she doesn't really have any experience on a board, and so she's a high-risk board candidate. And so it kind of explains why this process is so slow. And so, I guess I would say, as it relates to that, I'm calling on the other ladies on the panel here. I think it's up to all of us to make ourselves good candidates for boards. Because we can't just expect a board to say, hey, we need a female Margaret here, will you do it? You have to be the qualified candidate in the room too. And so, for me, I'm on local boards of my college, I'm on boards of the music conservatory in my town. I've been on our 401k investment committee board at Legg Mason. I think all of that is hopefully helping make me, a more aware board member. It helps me as I'm marketing to investment folks too, because I think from their seat. But I think that's how we change things longer term, is you got to make sure that the females are the qualified candidates.
Does anyone else have any other thoughts or other calls to action?
I'd just say the one thing that I've been focusing on lately is, once we get women in place, so they come in as analysts, they become associates, we seem to lose them when they become VPs. And so what I'm trying to do is figure out how to prevent that from happening. So I'm trying to mentor more women when they're at that level in their career, because what they tell me is, when they're analysts, there's programs and there's lots of stuff around them and it's keeping them engaged. Then they become associates and the same thing happens. They become VPs and they just fall off the face of the universe. And so I feel if we can step in and try and make sure that somebody's shepherding them along between that VP and executive director level, then we're going to do a better job at retention. So that's kind of my pet project right now.
A good one.
All right, well, I know we started a bit late and we're running a bit behind schedule, but we did want to open it up for Q&A. And I think Charlotte, yes, has the microphone. So if anyone has questions, Kathy, I know.
My name's Kathy Chrisman. I have a 4-digit charter number. I was like 3 years old when I took the exam. So I do challenge you all a bit on the work-life balance being so great, or else we wouldn't be losing so many mid-career people. And I think that it's the biological clock now is interfering with that mid-career. I was lucky I had my children young, and I could step out for 6 weeks only, but I stepped out for 6 weeks, and it was easier for me to come back. I think once you're in that mid-career and investment management in any area, you are behind. So things that I've been thinking about is, how can you job share in mid-career? Is there any way that you can offer these women, or men for that matter, a part-time job in investment management to make it more transitional in order to help them get back full-time? And I'm not talking about years and years, but we all know people who are struggling with 2-career families, young children, sports. So I'm a little surprised that you all think the work-life balance is so great. So I'd be interested in a little bit more discussion of that.
I said it. I didn't say it was. I didn't say it was easy. So I have an 8 and 9-year-old boys, and my schedule is very hectic. But you know what? I get in extremely early. I'm on the 6:06 train every day. And so I see my kids every night to help them with homework. That doesn't mean I don't work again after they go to sleep. But I'm still seeing them for dinner and homework, and on the weekends I turn it off until Sunday night. I don't do anything on the weekends. That's just me. So other people may have different opinions. And I absolutely agree with you that I think the VP issue is probably just that. It's people wanting to start families and thinking, I can't do this. So I think maybe some mentoring around that period is probably precisely what's needed.
Yeah, and I think the technology, the flexibility that technology has given us is something that is very, very important. I remember my maternity leave years, which I had 2 kids, now teenagers, to use that technology. I mean, because our brains don't turn off, right? We continue to think about investments. We continue to think. So that notion that you're on or off, no, you are having to do many other things, but you continue to think about these things, and your ability to contribute, even if it's like late at night or in the middle of the day or only early in the morning, that is something that is of value. And that continuity, to allow the flexibility for that continuity, is something that is important. We foster in our organizations, but I benefited from that enormously, from that flexibility, that technology, being there, having the conference, having all this technology available to us to maintain that connectivity is something that I valued a lot. And I thought that really, although maybe was it 100% or was it 80%, doesn't matter how sort of engaged I was during those years, but the continuity of the engagement is very important, not to sort of disconnect completely from it. And I think that is a type of flexibility that I think that's all women require during sometimes in their lives, and the organization should be willing to offer that to them.
One thing that we're doing, and this is for somebody who does disconnect completely, is we've now got a reentry program, which I think is great for women, and I think for men as well, I'm guessing, but people who have taken time out of their careers to raise their families. You've got people who have had these wonderful contributions in so many ways. How do we get them back into our organization? Because they have skills that we really want to take advantage of. So, and I've worked with a number of people who have come in through that path, and it seems to be working really well. So I would encourage firms to think about that as a way to encourage people who want to restart their careers after they've raised their families.
I too have a 4-digit CFA number. Really kind of a 2-part question for each of you, and that is, where do you think the easiest place for entry is for women? Is it fixed income? Is it portfolio management? Is it, classic research analyst? Is it something else? Either A, in the industry, and B, at your specific firm?
Do you want to start?
Yeah, I mean, I can start. So what I've seen more and more a pattern of is the way we take people into the organization is through our analyst program, which starts with the summer program. So you get the summer internship, of your junior year, and then if you do a good job, then you come back. And oftentimes what happens is people can come in to different groups. Some people may go into a portfolio management group, some may go into research, others can go into client portfolio management or sales. And then they have the ability to shift around as they move in their career. So I don't know if one's necessarily easier than the other for at least the way we hire people. And again, that's for people coming right out of university.
In Artisan, it's a lot more informal. We don't have all this very structured because we're smaller. So I can speak about what I know, which my path was, I became being an investment management analyst from the very beginning. And I think there is a lot of, I really think that was a path that gave me a lot of perspective and the ability to grow. I think to start in research or start in the sell side, there are other paths to it. My path and the way I see it and we recruit that way is people that know very little about what it is. They're curious, they're smart, they know the way around an income statement and a balance sheet. Those are the basic requirements. But from them is, in our case, that passion to see the world, that passion for emerging markets, and that desire to explore this. That's the requirement. And they start from the grounds up really doing this without having much previous experience in other areas of Wall Street or finance necessarily.
And I will say from our experience, similar, we don't really have a set program at Invesco as it currently stands. And I've seen so many different ways to get into the firm. I mean, back in the old days, you used to graduate from college and you'd go work in the call center and you'd take shareholder calls. Some people came in through the product stream. Some people came in through operations, and some people just, came in from as a junior analyst and worked their way up. And so I've got stories about everything. So I think that's part of the frustration is, every firm is different. And so if you're sitting down with a young person who's like, how do I get there? I think a lot of us I kind of fell into this. Sometimes I'd rather be lucky than smart, and I think that's what ended up happening and propelling me. Not to say but I'd rather be lucky. But there's a lot of different paths on how you get here, and I think that's the hard part, is how do you mentor somebody? Do I encourage them to become an analyst? Or do you say, well, you know what, I think it's better if you know the plumbing, on the back end, and then you get a strong reputation, and then we'll bring you to the front office. There's a lot of different ways to do it.
I would say, I don't think I'm a very good person to ask, I don't think I'm a very good person to ask about equity versus fixed income because I'm all equity. But I will say this, that after every summer intern we've had, I've said to her that the equity active management is a very mature industry. So maybe you'll get a job, an entry-level job in that sector, but it's unlikely. So I would say go to a bank, go to JP Morgan, go to any other bank, and do another summer internship if you're still in college, or do a 2-year program. The work-life balance will not be good, but it's terrific learning skills that then you can hopefully use that to transition you into where you think you want to go.
And of course, fixed income.
Do you have any thoughts?
No, I was just being, really, all great thoughts. But honestly, I think that whatever you do, learning the basics of the business are critical. So what we do is we bring a lot of our younger talent into what we call the data integrity group, where they learn what's a CUSIP, what's a cash flow, how do I settle a bond? I find in my career, I'm so thankful, because I was a mortgage person, but that I learned actually how mortgage securities are created and how cash flows work and the difference between an unscheduled and a scheduled principal payment. I'm telling you, people would not even know scheduled principal payments existed. And so the reason why I'm saying this is that whatever for your young talent is, get them in where they're really learning the fundamental basics of the industry, and then they're pivoting into different places to go.
All wonderful thoughts.
Hi, thanks for doing this panel. For someone who wants to eventually be asked to be on a panel, I was wondering, like, habits of successful people. Do you guys have any recommendations, or do you do anything that's a habit that you feel like has kind of led to your success?
Kristine, do you want to start?
Oh, yeah, sure. You're just picking on me today. All right, no, I love it. Okay, so habits. I would say perseverance. Like, I am like dogged. I can't even describe it because my whole life story, it's not just work, it's just sort of getting through things, like tough things, good things in life. I have 5 kids. So it's just like a lot of, just sort of showing up every day. And when you get overwhelmed, there's a friend of mine has shared this with me. It's like, just do the next right thing. Mm-hmm. So for me, whatever the situation, career setbacks, things that, and then also not like focusing overly much on my failures. And I think a lot of time, I've had failures. I made a career move, a couple career moves that were wrong and horrible. But I think what you learn is you learn not to be frightened by your failures, but to kind of crawl out and repivot. So I would say, what I did well with career development is took some risks and failed a few times and learned from them.
Lists, I'm a big list person. Personal lists, getting it all done, but also work lists, because for me, I think half the challenge sometimes in my job is it's really easy to just watch the ticker tape all day and realize you haven't done anything. And you need to just focus on, what are 5 stocks I want to look at? What are 5 more questions I want to ask to make sure you're continually making decisions and actually moving things forward. So lists.
Mm-hmm. Okay, so far y'all took 2 of my answers, but one of the things too that I've always told my team, you got to have fun every day, so it's kind of that whole saying, if mama ain't happy, nobody's happy sort of thing. So, you fake it till you make it. You come in, you have fun every day, even if it's just a frustrating day and you just can't face the same thing. Just fake it till you make it, because you want to make sure that you're bringing your team up. And the other thing too is I think it's following through, following up, because you have these great meetings and you're like, oh my God, this was great. We're going to do this. And everybody's, yeah. You've got this big cheerleading squad going on. 2 days later, you're like, what are we supposed to do after that? So it kind of goes back to the list. Follow up. Make sure you go back, because I agree. We will watch the market all day long, and then you realize you didn't get anything done. The other thing is close your email every once in a while, because that's another one that will suck you in, and you realize I didn't do anything, but just kind of manage all these problems that just pop up, and you feel like you didn't get anything accomplished. Close the emails, get something done, move on.
I have 2. I think one of them is we live in this industry of noise, right? We get bombarded with information constantly. It is our job to really process that. Get quiet, really. Close the email, listen to your own thoughts. And I think that don't feel you're neglectful because you didn't read the Financial Times 1 day or 2 days. It is quietness allows you to think. And I think that is something very important. And to the other point of failure, it's very important to feel the pain of the underperformance, feel the pain of those difficult years, but keep pedaling. I think that failure is really what makes you essentially getting to here, having experienced that and standing up and continue to work forward. That is very, very important as well.
I guess I would conclude with, I think those were all great points, and I'm mentally noting a few of them for myself. But I would also say to push yourself to do things that are out of your comfort zone. So I'll give you an example. About 3 years ago, my boss came to me and said, I think we should have an unconstrained credit fund, and I think you should run that. I was like, I don't know if I want to do that, and this was encompassing high yield and emerging market corporates and preferreds and convertibles. And I thought, but I'm an investment grade person. How will I do that? And yet it was the best thing I did. It's been really a great experience. I do that now. I work with other teams in addition to what I do in my day-to-day role, and it's been great. So take that chance and get out of your comfort zone. And back to the point about don't have this fear of failure. Unless you push yourself, you're never going to move to the next level.
So I've been getting the signal that we need to wrap it up for some time. So again, apologies that we are running a bit late, but please do note that all of our panelists will be out in the networking kind of cocktail reception area. So please do come seek them out, ask them any outstanding questions you have. I know that they're excited to spend time with all of you here. So I just want to extend a personal thank you to all of the panelists for traveling and for hosting us. And for agreeing to participate in what I think is such an important and valuable conversation. So thank you again. I appreciate it.